Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Mark, happy Friday. We're back to Digital Currents. Couldn't be kept away no matter how far, no matter any of the travel woes that I had. We're here and happy Friday, and we've got Blue today.
Yeah, happy Friday. We are almost perfectly matching. I don't have the cool sleeves, but welcome back from the Middle East. We'll probably talk about that. Look, it is a momentous day, potentially the day.
Right.
We get the big milestone. We'll see. In honor of that, quick reveal. Obviously, the orange pants. That was clear. But I had to. I guess how am I gonna do this? I'm doing this. I guess I'm gonna have to do it this way. So I have the original history of Bitcoin logo from all the days of Satoshi when it was BC. And yellow, and then just the yellow B, and then it changed in 20. I thought it was 11. Yeah, 2011 to the current orange logo, and then it's got the rocket ship on top. So clearly, as we are on the verge of 100K, we had to have the rocket theme going. But this is pretty extraordinary when you think about it on a lot of different levels. Not that it's just a round number. But it signifies that, this asset, one, isn't going away. Two, is probably going to continue to be embraced by the traditional. And in fact, this morning, I just saw this morning, there was a guy on CNBC talking about over collateralizing real estate loans using Bitcoin. And it was pretty interesting. So, you got Becky and the gang, talking to him, trying to figure it out. And they're like, well, wait a minute. So you lend him the money for the real estate to pay off the old loan. And this is a huge problem. So you have all these properties that have old loans that are basically underwater, and they need to be refinanced. And so they'll lend you that. Then they lend you a little bit extra to fix up the property, to get it fully leased. Then they lend you a little more, and you buy Bitcoin, and then you put that Bitcoin in the collateral basket along with the real estate. It's actually really kind of interesting. Now, there's a volatility issue. You got to make sure your assets and your liabilities aren't mismatched. You could have a volatility period where the Bitcoin value goes down. I mean, it is possible the Bitcoin prices will go down in the future. Not possible. It is likely, and they will. But I thought that was just an interesting example of using the tool, which is an asset that doesn't devalue as currency gets printed. It appreciates. So over securitizing the other asset. So just really interesting. And then you got, of course, Saylor out, pounding his chest on CNBC this morning as well, saying, you guys are still talking to me about volatility. My company's up 100 billion. No, was it?
Top performer.
$100 billion in 90 days. And I just raised $3 billion in a 20-minute phone call. And you're talking to me about volatility? Shut up. He totally shut the hell up.
So maybe that's a good segue, Mark, because, Saylor has been on a tear. We address it from time to time, but it's probably worth double tapping here. So, this started way back in 1989. This is a great example of how businesses don't always do what they were set out to do, but they've kind of continued, and finding their niche, right? And so basically, they have now amassed a real war chest, and also have done it in a really smart way. But, this kind of leads this idea that, there are good and bad leverages out there, right? Because obviously now he's got this asset at under 50K. And there was a point that you mentioned a couple months back, and actually was double tapped by Novogratz yesterday, which was, we 100K is coming and we might rally a little bit more, but let's pump the brakes over a little bit, because there's still a tremendous amount of leverage in BTC now that will cause a little bit of a market correction, which we are expecting. But maybe that's something to think about, Mark, because this was something you've been calling for some time.
Look, cycles aren't going away. Everybody's like, oh, the cycle's over and we're in a permanent new bull market. No, we're not, because humans are going to human.
Right.
And look, the amount of leverage that Saylor's using in the MicroStrategy structure, or, the board I sit on, MetaPlanet, trying to do the same thing in a smaller way in Japan, those are prudent levels of leverage given the asset and the volatility and the asset liability match. Which is, again, if you have a short-term loan, like if you have a loan that has a 1-year duration, you better not take it out against an asset with high volatility, because inevitably what's going to happen is you're going to get that volatility just when you need to refinance the loan, and the bank's going to say, no, give me my money back, and you'll be forced to liquidate. And people forget that not that many years ago, right, because Michael Saylor's only been doing this for coming up on 5 years.
Yep, in 2020. Mm-hmm.
That he got to a point where, by some calculations, he was on the verge of a very big margin call, which would have triggered a very nasty unwinding. Because, virtuous cycles are awesome, no matter what they are, whether it's fashion, whether it's, an asset, whether, anything that becomes virtuous, self-fulfilling, popularity is amazing. But the vicious is on the other side, is equally bad. And in investing with leverage, to your point, if people start buying an asset, the first buyers are historically investors.
Right.
What's an investor? An investor is someone who does work, comes up with the value of something, and says, the price of that asset is below the fair value. So I'll buy it. And assuming that it's going to go to fair value. Okay. And that starts to move the price toward fair value. Now, as the price starts to move, other types of investors, traders, come in, say, oh, that's what I need. I need movement. I don't really care what the value is. I just need movement. And I want to scalp a little bit here and there, and I'm going to trade. And trading's super hard. I stink at it. Most people stink at it, the large majority of people. Now, there are a few that are really, really good. I mean, there are some legendary hedge fund guys who are really good traders. But it's like Paul Tudor Jones, amazing trader. I mean, amazing. But the dude literally had screens installed sideways on his bedside table so that he could wake up in the middle of the night and not have to lift his head to call in the trade. I'm like, no. I mean, look, I wanted to stay up last night. I doctored the no sleep till Brooklyn I made no sleep till B100K, which, worked. But I didn't want to go to sleep, but I need sleep. And so, but I'm not a trader. We don't trade our Bitcoin positions. We buy it and we hold it. And so I could go to sleep. But if you're trading, you have to be on all the time and you got to be careful. But anyway, so the traders don't really care about the value. They just care about movement. Well, then as you hit fair value and you start to go above fair value, well, then the speculators come in. Well, who are speculators? Well, speculators are the other side of hedgers. Well, who are hedgers? Well, hedgers are people who produce some asset who need to sell that asset in the future. So in Bitcoin's case, it's the miners, right? They produce the Bitcoin, then they need to sell the Bitcoin. They sell in the futures market, right? They sell their future production to lock in their profit, to pay their bills. Well, a speculator is just the opposite side of a hedger. That's not an evil thing. It's part of the market. So that accelerates the activity. And that's why we see these ramps post-halving, because those block rewards are down from where they used to be. And so the miners need more cash per unit of sale, so they hold on until someone offers them more. That's how bid offer works. But then the problem is the last phase of the market is the gamblers. And the gamblers not only come in irregardless of where the price is relative to its fair value, they lever up. And inevitably, the first people that lever, 1 times, 2 times, fine. But eventually 20, 30, 50, they're levering the futures market. There were stories in the early crashes in 21 and 17 of people levering 100x on an 80 vol asset. If you have 1% down and 99 cents of leverage, that's a bad idea. And I've told, I shouldn't rat out my brother, but I tell the story. He called me up one day and said, they stole my Bitcoin. I'm like, what are you talking about? He says, well, I was on Bitfinex. I'm like, stop. Nope. You took an 80 vol asset and you levered it up 100 times. And in the virtuous, that was great. But in the vicious, they made a margin call and you couldn't. And that's not theft. No one forces you to take the leverage. Right. People take the leverage because it seems good. I mean, think about housing crash. Normal house, you put down 20%, you borrow 4 times leverage. 4 times leverage on your largest asset? Oh, that's so reckless. No, it's not, because you don't mark to market every day. So it's awesome. And that was the American dream. You bought a house, you levered up 4 times. Well, then people said, well, if 4 times is good, how about 10 times? How about, 5 times, 20% down. How about 10 times? We put 10% down. Well, now if the price goes up, 10%, I've made 100%. It's awesome. Well, what about 97 to 3? How about 3% down, the FHA stuff? Well, what about 1? How about just 0 down? How about infinite return? Well, great, until it goes the other way. So that's a long answer to leverage is a tool, and it's a great tool, used appropriately and used correctly, but inevitably humans are going to human, and greed, for lack of a better term, Gordon Gekko, is good until it becomes excessive, like most things in life. Most things in moderation are good, but in excess are bad.
So we can chronicle their rise, Mark, because like you said, in 2020, they had already been kind of in zombie mode for a little while. They were one of those victims of the dot-com crisis and the crash. So in 2020, that all changed when they sort of made this public declaration that they were starting to buy Bitcoin, right? So they actually said that they disclosed 21,000 plus Bitcoin worth more than 250K at the time. And they were the first to do this, right? The first publicly listed company in the U.S. to add Bitcoin to the balance sheet. And then they said it was the belief that Bitcoin, as the world's most widely adopted crypto, was a dependable store of value and attractive asset with more long-term potential than holding cash. Sure. And that's a really important quote, because the company does not really do too much revenue outside of, what it's holding here. But let's just talk about the numbers, right? So it has gone up an astonishing 2,500% since it first started buying Bitcoin, making it the best performing U.S. stock. It is now thoroughly in the top 100 by market cap. It holds more Bitcoin, Mark, than the entire corporations of Nike and IBM do cash and treasuries. Only about a dozen companies like Apple and Alphabet actually hold more corporate treasuries on their balance sheet. So now the idea here is they have been kind of storing this over time, right? So they had that initial purchase for $250 million. They've gone on to do that dozens of times and have more than 16 billion, right? More than 331 million. And then last week, they made the disclosure 4.6 billion purchase, which would be the largest yet. That will push them to over 30 billion, right? So how have investors responded? Basically, at 100 billion market cap, they're larger than PayPal, which was the...
So then what's amazing about it is what people forget here is he figured out this amazing arbitrage. And he was not the first one to do it. People have been doing arbitrage for a long time. There are trillions of dollars in the mutual fund and ETF world, institutional investor world, that are prohibited by law from owning certain assets. They can't own commodities or real estate or equities or Bitcoin. And yet they can own bonds. Okay, but those bonds can be collateralized by any number of things. They could be bonds collateralized by corporate equity. They could be bonds collateralized by cash. They could be a sinking fund. They could be by treasuries. They could be bonds collateralized by some physical asset. It could be anything. So he said, well, what if I collateralize the bonds with Bitcoin? And so basically I'm creating a CLO, a collateralized loan obligation. And so the person who needs the bond will loan me money, and then I take my equity risk plus the residual equity risk of that transaction. And so I'm getting effectively double equity or more for my assets, and they get what they want, which is bonds. Now, he made them convertible bonds, which allowed people to participate in the upside if the company were to increase in value, which it has. And the crazy part, he got them for no interest. I mean, 0.625%, but the latest one, literally zero, which is pretty amazing, right? People lend you money for zero. And in so doing, he's using financial engineering to separate out the things that people want and don't want, right? You have a whole class of investors. They want stability and a guaranteed return, a contractual return. That's what a bond is. They don't want the residual return, even though it's probably larger, because it has risk. Equity has risk. That's why you get paid 7% above risk-free for equity and only 2% above risk-free for bonds, because bonds are a contractual claim and equity is a contingent claim. Now everybody says, well, what happens if he can't pay back the debt? I'm like, well, again, if you are fully collateralized by the asset, okay, and then if that asset doesn't change in value at all, you can pay back the debt at any time, right? Because it's the same amount. Well, if that asset actually appreciates, you can pay it back and then some. Well, what happens if it depreciates? Yes, then you definitely have a problem, because then you have to dig into the equity value of the company. Well, what's the equity value of the company? Now, to your point, the software business doesn't have a whole lot of equity, but it has some equity. And then there is this concept of Bitcoin yield, which is when you have this asset, inevitably there are going to be some periods, which we have seen, where the devaluation of the currency causes the value of your Bitcoin stock to rise, right? The Bitcoin doesn't change. One Bitcoin is always one Bitcoin. But the value in dollars has increased. And so if you, at that point, issue more shares or bonds to then acquire more Bitcoin, you're basically creating value the same way that another company creates value by selling more software or whatever their business happens to be.
Yep.
And people just don't want to listen to that. They don't want to understand. They're just like, oh, it's a Ponzi scheme. You're taking new people's money and paying off old. No. I mean, everyone has a claim on a certain amount of asset. Now, that asset value does matter. And as I said, there was a point at which the asset value had dropped. Yep, Bitcoin went down. And people were like, oh, my God, if he had to pay back the loan, then he wouldn't be able to pay back. But he didn't have to pay back the loan. That's the thing. If there's an asset liability mismatch and you have a too short a period loan and you're forced to liquidate at the wrong time, bad things happen.
But we've got a good segue, and we'll do a double bonus this week on some charts. This is a mini chart and kind of a segue into the next story. Let me know if you can see the screen, Mark. For those that are on audio only, we are showing a tweet from Radar Hits, which shows a chart on one side. It is the combined market cap of JP Morgan, Visa, and MasterCard. And on the right of that is the basically the market cap of BTC, surpassing those at 1.86 versus 1.76. The reason that this view is compelling is because MasterCard and JP Morgan have joined forces to kind of streamline on a cross-border payment solution. So Mark, you remember Onyx, the first kind of, bank-led institutional blockchain rail. And now basically that's been renamed. It was renamed some time ago in November, Connexus. And that basically now is this idea to kind of merge with MasterCard's multi-token network, MTN, to establish a payment availability and reduce time zone frictions and accelerate settlement speeds for mutual business customers. So this is basically what Bitcoin is supposed to do, right? And it takes three of these guys to amount to where Bitcoin is now. So this bridges a couple of the things that we're talking about on, what could happen if you're on the wrong side of the short. Well, you're, short of the combined heft of, three of the largest American financial institutions, three of the largest global institutions. I know, Mark, we've made fun of Onyx quite a bit over the years. It seems like they won't go away. They have rebranded themselves. I didn't know this, but apparently, Onyx, now known as Connexus, they process over 2 billion in daily transactions and support on-chain Forex in USD and euros. I'm not sure, to be honest. I don't want to call, conspiracy. I'm not sure how much of that 2 billion is real, who's actually using that.
Yeah, wash trading, internal transfers. He is mostly internal transfers intraday.
So, Mark, what do you think about this kind of a move? It takes three of these guys to come together to still not even be larger than where Bitcoin is today.
Look, it's what you and I do every day.
Yeah,
we focus on innovation. Innovation is going to continue to happen, but the incumbents that get displaced by that innovation don't go away overnight, and they don't not fight. The reality is, people forget that Visa and MasterCard are these incredible duopoly companies. If you look at their stock chart, it's just a license to print money. And they didn't exist 100 years ago, right? There was a whole different way that you would transfer money between individuals or businesses. And Visa came along and said, we own the Sacramento market. Like literally, Bank of America said, we own the Sacramento market. I think they had 90 some odd % of all the businesses. Let's try this little thing. We're going to print this card. And it was cardboard. It was a cardboard card. And we're going to hand it out to all of our merchants. And we're going to see if they would use that card and that database system to basically batch transactions. That's all it is, right? It's a batching of transactions. But then you get to skim a little bit of that transaction, and you don't have to settle to the base layer, right? The ACH and Fedwire layer of money that often. Well, at first people were like, no, I use money. I have a wallet. I mean, I don't want this stupid card, and I certainly don't want a credit card because I like debits. I like cash. But over time, people are like, this is more convenient. I mean, I give them my card and I don't have to pull out any money and I don't have to carry the money and I don't have to settle up once a month. I mean, that's pretty awesome. I mean, how are they doing that? And that 3%, I don't really feel that because I don't pay it, right? The merchant pays it. Well, then the merchant just marks up the asset. But okay. If you've ever been to a trade show or like a flea market, you know that you actually pay it because they're like, oh, you want to use a card? Okay, that's 5% more. Like, but I thought the transaction was only 2 or 3%. Yeah, I know, but I'm charging you 5. Anyway, so those businesses' market cap are going to shrink, and the Bitcoin market cap and the other payments rails market caps are going to continue to rise. Stable coins, which I haven't even talked about, which we could talk about all day. Sure. I mean,
the question I have for you is, we talk about this analogy of like, we look at something like Netflix, we've talked about a lot. And we mentioned, Netflix, yes, grew, but it wasn't so much pure organic growth as it was shifting away consumers from the other broadcast networks like
ABC and CBS, baby.
If that's what's going to happen with something like we see this
100%.
Yeah.
100%. And that's the perfect, because ABC, NBC, CBS were unassailable.
Right.
They were super valuable. No way. I mean, they owned everything. They owned all the content. They owned all the eyeballs. They owned all the ad revenue. But they had tech debt.
Right.
Okay. What does I mean by that? Well, they had all this money invested in their ad-based revenue system. So when Netflix came along and said, hey, subscription, watch when you want, watch what you want, when you want. Well, you don't have any content. We'll rent it. We'll get it. We'll see what people actually want before we buy it. Instead of just having all this content that nobody looks at. And nope, we're not going to do that. And it was literally like this. It was like a melting ice cube rolling downhill and then refreezing. And today it's not close. All the market cap went to the innovation. And I'm telling you, it's better to watch stuff when you want to watch.
Oh, yeah.
It just is. I mean, as much as I love live football, like, I mean, it's almost football weekend again, as much as I love it, and I love, and it's better to watch the recording and do it in an hour instead of 3.5. It just is. Well, as long as you don't know the outcome. If you know the outcome, it ruins the whole thing. But if you can record it and not know the outcome, and then skip the commercials, skip the, and look, I know being a color commentator for football is hard because you got to think about this, 3.5 hours, 11 minutes of action.
Wow.
11 minutes of actual action. So you got to talk for 3.5 hours or 3 hours and a quarter.
No.
That's hard. And so me making fun of them is not fair. But I don't need to listen to all the anyway. So
yeah. Well, one story, Mark, I guess as we shift into AI, we had to talk a lot about crypto and BTC just because it is just so historical we're seeing. But another thing that I thought was pretty interesting was our CTO in chief, Elon Musk, and the XAI. I'm sure you saw this, Mark. They have now kind of led another momentous milestone in a 50 billion valuation, led by a couple of very interesting people. So his XAI is his company. So he raised 5 billion, and actually QIA, Qatar Investment Authority, was a member here, along with Valar and Sequoia and Andreessen. And we argue that these guys are not really VCs anymore, as they are another kind of category of inventor. And so, they were founded XAI in 23, and basically they're offering this Grok chatbot, not our Grok, Grok. It's available to businesses and premium users of Musk's XAI so that they can create more bots. No, just kidding. Just so that we can improve X. And so apparently they're generating 100 million in annualized revenue and have plans to use the fresh funds to acquire 100,000 NVIDIA chips and expand their data center. And Musk has clearly edged his way and into the seat of power, which is no surprise for the richest man in the world. And I think, this is showing here that, he's got some potential plans down the road. We've spoken about, what it could mean for expanded use on Doge. Now with XAI, I always thought it was a little bit, complicated to understand how you can be the CEO of more than one entity. He's done it, multiple times.
Yeah.
Mark, I mean, I think this is a big story here. I thought XAI wasn't doing that much. I may have been misjudging how many things they actually have accomplished. I wasn't even sure about that revenue figure. I had to double check. 50 billion is quite a hefty valuation, even for an AI company. Ooh. Now we're seeing, sovereign wealth funds participating in this. As we mentioned, sovereign AI is a real category. We've seen it multiple times.
So many important points there. And unfortunately, I will say as the caveat, unfortunately, the track record of those very, very large pools of capital participating at the right stage of hot tech deals, it's not very good. You go back to a number of the deals that the Saudi funds participated in alongside Masasan and SoftBank. They didn't turn out very well. And because when it's easy to make an investment. Like everybody's telling you how smart you are and everybody's saying how great this is. And oh my gosh, Elon is Elon is great, right? He's a great innovator. He's a great, more than just an innovator. He gets stuff done. I mean, to your point, I don't know how any single human can do it. And now he's posting videos of speed running Diablo in under 2 minutes. And I'm like,
Hey, he's a top 20 gamer in Diablo.
I know. And God love it. I mean,
He must
but because I just know, you and I were both kind of gamers. I wouldn't give it a big G game. I mean, but I like video games. I like them a lot. And I spent a lot of hours, more hours than my wife would like me to. But even after all those hours, I'm definitely not winning the tournaments. And so, for him to do that, and now in the video you don't actually see him with the controller. I'm not saying that it's not him. I'm not. That's not my point. But I'm just hats off, baby. That's that. But
and Diablo's one of those games too, Mark, where you have to just put in the hours, because if you don't get the gear, you don't understand the power of the items, you're not really going to advance. And top 20 is it's no fluke.
No. It's incredible. It's incredible. But the point there is that yes, he's amazing, but that's part of the problem. Is 100 million not of revenue, but of ARR. So you're taking the last month and multiplying by 12.
Yeah.
That's a made up number that got made up in our industry. It's not real, but okay. So ARR, because 1 month, things are cyclical, seasonal. It doesn't mean you're going to have a straight line but whatever. But 100 million, 50 billion that's a gigantic multiple of revenue. That makes NVIDIA at 36 times revenue seem cheap. Now, I said 36 times revenue, not earnings, right? 36 times earnings is expensive. 36 times revenue is insane.
Yeah.
And it's insane. It's insane. I mean, it's totally insane. And it can't persist forever. Now, it can persist longer than I think. And it has persisted longer than I think it can. But there is no math you can do on either one of those valuations where you can grow fast enough to get to that valuation. So what's the return to those equity investors in this round? Low.
Right.
I mean, probably negative, but you get to say you're in the deal. But my point is, where you make the most money is when you're making the investment and people are saying, you're an idiot, right? You're dumb. That's stupid. I've never heard of this CEO. I've never heard of this company. I've never heard of this technology. That's when you should be making the investment, right? Now it still may fail, but to make an investment that just feels so good, history tells us. And look, this is why humans underperform, right? I use these stats all the time. 20 years, this is JP Morgan data. 20 years, stocks, 8.5. Okay, a little bit less than their long-term average. Bonds, 5.5. So all you had to do, pick one. Or pick 50-50. Or pick 80-20. I don't care. Just pick one. Okay? And you would have made somewhere between 5.5 and 8.5. Let's call it 7. Nice 50-50 split, rebalanced, 7%. The average human over that same period made 2.6. Why? Because humans do two things really, really well. They buy what they wish they would have bought, and they're spectacular at it. They pile in after something's already run up because it feels good. It feels good to buy what everyone else made really expensive, and they sell what they're about to need, right? 1 year ago, let me get the exact number right. 1 year ago, we're not even talking like 10 years ago or a long time ago. 1 year ago, Bitcoin was $37,000. $37,000. And people were running out of the store saying, it's going to zero. Oh my God, you can't touch this thing. Now at 99,000, oh my God, I got to get some. I got to get some. Anyway, so the same thing is true here. Jensen came on.
Oh, yeah.
Said that, what Elon did, no human being could do. And it was like, what are you talking about? He installed 100,000 AI chips in a data center in whatever it was, 3 or 4 months. That's impossible. And they showed the nice video of this nice clean room. I mean, nothing's impossible. I mean, ever seen the Chinese build a bridge? I love the time lapse of them building a bridge. You go to Chicago, the same road in Chicago and the same bridge has been under construction since I lived there 40 years ago. They're still not done. Okay. But there's no workers. I mean, you drive by, there's no workers. It's hard to finish something if there's no workers. If you put a bunch of workers, and what Elon, remember the tent when everyone was saying Elon will never deliver all the cars? Elon put up a damn tent and he got more workers. Not sure where, and I'm not sure how he trained them, but he did it. And so getting stuff done and throwing the resources at it is a superpower. That is
maybe the last thing we'll close on this point, Mark, before jumping into the chart of the week is the point that you made on timing, right? Because just for the relative scale, this company reached 50 billion in valuation in 16 months after its founding. 6 months. So the market leader, we would say is ChatGPT. It took them 9 years to reach that mark. And eventually, they went to 157 billion, but now they're ahead of some people who have a lot more traction in the space. So they're ahead of Anthropic, 19 billion, Perplexity, 2.8 billion. So there's still a value there. And they're even getting close to like big fashion giants like Shein, in the fashion space, which is 66 billion last year. We thought that was kind of ludicrous. So this really shows, yes, you have to build things quickly, but you also have to build things at the right time. And it creates this FOMO effect, which, as we know, is not always the most prudent investment strategy. You should, really judge things.
Well, and this goes to price is a liar.
That's right.
The price is just what two people agree to exchange a small amount of a good or service. It's not the value. So the price at $50 billion does not mean that company's worth $50 billion.
Fair point.
It doesn't mean that at all. What it means is somebody, and we know who the somebodies are. Now, look, and not to pick on them because they're way more successful than I could ever dream of being. But, a couple of the firms that you mentioned, on the VC side that we argue is doing some new asset, whatever it is, not early stage VC, were investors in companies like FTX. FTX at $36 billion valuation on 40 million of revenues. And where'd that go? Well, it went to zero. And I'm not saying growth is going to zero. That's not my point. And I'm not comparing the businesses, but I'm just saying those same investors looked at that and said, huh. And again, I hate to pick on SoftBank because, again, he's way more successful than me. WeWork, does that ring a bell to anybody? I mean, look, I listened to Adam Neumann early on when it was valued at $10 billion. And the guy was hypnotic. I mean, he was a very, very good salesman. And I went to the first site in New York and it had a cool vibe. I mean, the beer keg was cool and the people hanging out were beautiful. And I mean, it was a cool vibe. But then when we talked about it in investment committee, we're like, this is real estate. This is fractionalizing real estate and renting it out on a per square foot basis. There are two public companies that do this. And here's their valuation. And this is what this guy says he's worth. He says, well, we're a tech company. No, you're not. You're a real estate company. I mean, you're renting real estate. It's not, you're not like putting people in the matrix. I mean, you're renting physical real estate. So we didn't do it. But look, SoftBank, just because someone's a super famous and great investor doesn't mean they don't make mistakes. And I'm not saying this is a mistake. I would not have invested in that deal. Full stop. No way. I don't I want to invest in AI deals. I like AI deals,
Right.
but there's a valuation discipline. And maybe this is why I'll never be a famous venture capitalist, right? I just have to, be happy with being a small, successful venture capitalist, right?
This could also be more just a potential hedge against all the other AI companies that might be hit with potential regulatory roadblocks because they're not part of the axis of.
Oh, now that is a very good point, right?
That's the investment move.
But even that,
Yeah.
I think that could get you almost your money back, almost. But that's not why you do venture.
No.
I mean, because you're exactly right. Look, if you wanna invest in things that are safe, definitely invest with people who are on the right side of regulation.
Right.
No question. And we can go chapter and verse deep down the rabbit hole of, let's see, Elon got involved in what? He got involved in payments and monitoring people's activity. And he got involved in space and putting up a satellite network that spies on people. And he did this thing where the cars actually have video of you, and so you're spying. Those are all government activities, and he got special treatment from the government. Either he's the best governmental regulation manager in the history of mankind, or maybe he's part of it, right? So, anyway.
That's right. And I think we don't have enough time to get into the next chapter of Chip Wars. We'll save it for next week. But the teaser is that the ship war and the chip war have collided because the open seas cables in the Baltic Sea got hampered. And I would love to get into this story. I just want to tease it out, and then we'll have to pick it up more next week as we shift into this idea of the election impact in the crypto sphere. When we look at kind of this relative value change, there have been a lot of new names into this top 10. Some things that I am still kind of getting a little bit up to speed, as I'm not the biggest meme corner. Mark, I know you are not either. This is going to be a very interesting look to see basically post-election, what has been the impact in the total relative change. So I will display the screen. Let me know when it is visible, Mark, and we can hop on in.
Yep, got it.
Okay, great. So what we're seeing here for those on audio only, we'll remind you, check us out on YouTube. You can see all of the amazing charts of the week and more. So what we're seeing on top is OM or Mantra. That's a layer one blockchain, Mark. They're focused on RWAs. And I think for me, that's the one that I can kind of wrap my head around the most when I see this. And of course, Ripple is on here, XRP. We spoke about it last week as it could be a beneficiary of this favorable tax treatment to U.S.-based crypto companies. But, what you are seeing here is that, meme coins continue to grab attention despite, people questioning what their real utility is. Maybe we always look for pairings, Mark, in terms of what the Web 2 comparable is. Maybe meme coins will be the new social media of Web 3, right? Maybe.
Well, look, you got a couple things going on here. One is it's just the law of small numbers.
Yep.
Right? When something is smaller, it's easier to go up a huge percentage than when something is larger. So as much as Bitcoin or Ethereum or Solana have moved, Solana made a new all-time high yesterday, which I actually didn't really think it was going to do. So bravo to them. You look at a bunch of these literally meme tokens where it's literally just people buying and selling, trading sardines. There is no use case. At least, now with something like Doge, you can say, well, maybe there could be a use case if Elon can figure out a way to make that part of the government. The three that jump off the page to me here, though, are XRP, Cardano, and Hedera. And why is that? Well, if you go down the rabbit hole, you say that all of these three things, again, have no use case. They have really great marketing departments, and they have a lot of political connections. XRP in particular, Garlinghouse, right, went to school with a bunch of the, the bigwigs and the higher ups. And there's a lot of talk about, the big institutions wanting to use that as their core blockchain technology to maintain control through SWIFT and the banking system. And so this would be like the base layer for the WEF group. So then you got people like Cardano and Hedera saying, hey, well, we're going to be important in a Trump presidency because we got things that are interesting. Well, I don't know. I mean, yeah, if you want to be the base layer for a CBDC, okay. I mean, yeah. I mean, if you could win that government contract through political contributions, fine. But I don't want a CBDC. I want open network, transparent, free currencies, not surveillance tech. So I've yet to see anyone, I've yet to meet anyone ever, literally, who's working on something in Cardano. I have met lots of people who own it and keep saying it's going to go up someday and how great Charles is. Okay, he's super rich, but I've never met anyone, not anyone. I've never met a founder. I've never met a developer. I've never met anybody who's working on it. So I don't know. Those three jump off the page at me at probably Short Squeeze maybe, or Hope Springs Eternal, or
Here's another view, Mark, of the largest relative change in open. So slightly different in terms of one was the percentage, and here is kind of on the dollar side.
There you go.
Of those same companies. So you can put a little bit more context here. So, what jumps out here is XRP, to your point. And I had somebody, I think it was maybe 2 years ago, I was speaking at an event where I was talking about the metaverse and kind of the impact in Web3. And so somebody at the end comes up to me and says, hey, my wife really loves Ripple. I keep telling her I'm not really sure of the use case. What should I advise her? And I said, first, I would agree with you. I'm not 100% sure of Ripple either, because I can think of multiple protocols that will outperform its benchmarking or projects that they've got listed, but it does not seem to be going away, right? And I think it's just sort of, there is this idea of survivor bias when I look at something like Ripple, 157% increase. I mean, that's pretty notable.
Sure.
I think that, it's also quite larger than the rest. Again, Mark, it really pays to kind of align yourself with the right side of the law, which is ironic as all heck, because
look,
us here is just a couple.
History is written by the winners, and being on the right side, being on the right team is really important. And the people at the top of Ripple do have friends in high places now, and it's possible that something good for them will happen. I'm skeptical. I still think it's not a very useful protocol. It's funny. I do this show with a bunch of XRP Army guys, and I do it probably once every couple months, and they've been trying so hard for years, like to get me interested. And look, I go on and talk about other things like Bitcoin and whatever. And they're great. I like the people. I think and the guys, they're smart. But I just have not been convinced. And they've tried all kinds of different things to say this is why it's good and this is why the technology is good. I'm like, well, okay, but none of that's really compelling, and the number go up is not enough, right? And yeah, we're back to where it was, in 2 cycles ago. So 8 years, we're back to where it was. Okay, that's something. But I I just don't see it. And especially the thing I don't like about it, and it's just my own bias, I don't want anything that's planning a use case with the incumbents. So if you're working with, the Bank of International Settlements, I got no time for you. That's what Ripple's doing, or XRP is doing. If you're planning stuff with JP Morgan, I got no time for you. Because I want to be part of the side of history that displaces the old tech and busts the monopoly that has existed for 839 years that I think is, past its useful life. I love the fact that peer-to-peer now exists. We don't need financial intermediaries. And that's a hard pill for financial intermediaries to swallow because remember, one person's cost saving is someone else's revenue.
I love that.
Right? And that's been true forever. Yeah. And I don't wish ill on anybody, right? I don't love the fact that a whole bunch of mom and pop, five and dime stores in every small town America had to shut down when, Target and Walmart and better retail. And it pains me a little bit to see, real businesses getting displaced by technology. But I'm always heartened by the fact that each one of those new technological innovations creates more jobs than it erases. Now, yes, there's a retraining element and all this good stuff. But the future is always bright, and it's brighter when there's innovation and technology and less bright when you try to cling to the old. And
well said.
I'd much rather, focus on the new.
Well said. And I think, that's a good place to wrap and tell our listeners that we will be off next week for Thanksgiving. We might be able to release something from the archives. Mark, I recorded something pretty cool with our friend Tafiz down in Dubai. We'll see if we can kind of get that wrapped up and available to our audience. We'll remind everybody to sort of give thanks. And we wanted to just start by saying thanks to everybody who has been tuning in, subscribing. The numbers have been great. And we hope that we'll continue to kind of report post-Thanksgiving on what might be a really magical moment over the next couple of days. So we'll remind our users, as always, to rate, review, and subscribe. And as always, stay current.
All right. Well, thanks, X. And I am grateful to everyone who listens. I'm grateful to you. Best hour of my week. And it's just so much fun to do this together. And, everybody enjoy the best Thanksgiving ever. And give thanks. Give thanks for Satoshi Nakamoto and give thanks for innovation. Give thanks for living in this great place and for the bright future ahead.
Well said, Mark. Well said. And I thank you as well this is one of my favorite, not my favorite hour of the week. Love doing this show. I think it really not only allows our listeners to stay current, but it allows me to stay even more current because we need to digest this all for the listeners and kind of tie all the themes. So really appreciate that and always remind our users to stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.